Today we're going to be talking about, thanks a lot, appreciate it. What we're going to be talking about today is tariffs and the impact on the markets, okay? So that's the big bad word that's been going around lately. Tariffs. Are we going to go into a recession? Are we not going to go into a recession? And how bad it will be, how impactful it will be. Well, let's take a look. And what I do know is this. I've been investing for a long time, and what I know is this. Whenever you have a pullback, and a correction. A correction is defined as a 10% pullback or greater. The markets, the S&P does that once about every 40 years. Okay. The NASDAQ does that once about every 10 years. So we were due. We didn't have one in 2023, didn't have one in 2024. We definitely had it in 2022, but we were due in the NASDAQ. And we've got it. And we had one in the S&P 500 as well. So maybe a little bit more frequently of late as post-pandemic. But what we do know is this. We know that every time the market has pulled back, it's always gone to an all-time high. And I know it's very difficult to do mentally, but when there is fear out there, that's when you have to train yourself to be the most aggressive as you possibly can. Within your risk tolerance. You have to train yourself to be able to take risks and invest for the long run. You have to think about it. Has anything fundamentally changed with the companies I'm invested in? If it hasn't, then you have to look at this as a buying opportunity, right? Now, the good thing is with the options world, when volatility goes up, i.e. fear goes up, you get paid more in premiums. And sometimes when the market goes down a fair bit, you're better off maybe just buying stock entirely. And that's exactly what we've been doing. So I'm going to go over exactly what the markets are doing. We're just going to wait a minute or two for David Jarvis, the portfolio manager, join on. He should be on momentarily. But I think what Warren Buffett said sums it the best. When others are fearful, be greedy, and when others are greedy, be fearful. Every time I have seen a market correction, okay, and I can recall a few in recent memory. 2018, there was the inverted yield curve. 2020 was obviously the pandemic. That was a bear market that lasted only 6 weeks or 7 weeks. 2022, major bear market, okay, which happens not that frequently, but it does happen. But where are the markets today? As of a month and a half ago, or a little over a month ago, we were at an all-time high on the S&P 500 and the NASDAQ. Now think of this logically. Trump has always boasted about having a great economy and a great performing stock market. Okay, so when you've had this much of a pullback, and we had as much as 14% on the NASDAQ pullback, and we had about 10.5% or so on the S&P 500. We've recovered a little bit, but it's still a very uncertain environment, and the markets do not like uncertainty. That's the main thing you want to keep in mind here. So as hard as it is to do mentally, this is why you have to keep your head straight during these times. Sometimes you don't want to look at your account, but if you have cash available that you are not using and you feel comfortable, this is the time that you want to look to be aggressive. Because like I said, markets have always gone to an all-time high. So for example, if the S&P rebounds to its all-time high, we're about 11% from its all-time high, right? So some of the stocks that, perhaps that are more volatile in the S&P, they could be up 15, 20, 25% by the time that recovery happens. And if it goes beyond the recovery into an all-time high and finishes it higher for the year, even better. But this is the time that you want to look to be aggressive. And that's exactly what we're doing in the fund. So I'm just going to quickly talk about what's happening in the fund. Okay, so what is the impact on these tariffs? Everyone's been hearing about it. You got tariffs on let's take a look at what's happening to tariffs on the U.S. economy and what's going to happen in Canada and globally. All right. So we are in the middle of this right now. February 1st, Donald Trump imposed 25% tariffs on Canada, Mexico, and 10% on China. That would come into effect on February 4th. Now, it didn't come into effect February 4th. It got delayed. Now it's March 4th. Increased the tariffs on China by another 10%. On March 5th, Trump exempted auto parts from Canada and Mexico until April 2nd. So that's the big date we're waiting for. But look at the first 3 points. What are we experiencing right now? We are experiencing uncertainty. Now, the majority of this probably won't happen, but the markets hate uncertainty. But that is where your opportunity is. That is where the opportunity lies. Okay. March 6th, President Trump exempted imports covered by the USMCA deal, which he negotiated in 2018. Now, the USMCA covers 38% of imports from Canada, while it covers about 49% of US imports from Mexico. So we'll see how that goes. And I know what he's trying to do here. What he's trying to do is a couple things. A, he's trying to get some negotiation leverage. That's fine. He might want to negotiate a more favorable term. Secondly, what he wants to do is that he wants to perhaps bring manufacturing back to the United States. But let's take a look at auto imports, for example. It's not something that you can change overnight. You can't just build a factory in 2 days. You're not going to build a factory by April 2nd. Where will you get the raw materials like aluminum? So a part, aluminum may come from Quebec, then the part goes to Ontario, it's manufactured, shipped down to Michigan, built in a car sent out, either, it's very intertwined. So I'm going to be really interested to see how this goes and unfolds. But you can see the bottom line is there's a lot of chaos in the markets. Fear is really high. But like I said, that's where the opportunity is, okay? So Trump also announced a 25% tariff on the EU. Now, all these countries are introducing retaliatory tariffs on the Americans. So this is not good for anyone. Why do you have free trade in the first place? Free trade is very simple. Okay, the reason is simple. Let's say I'm the United States and somebody else is Canada, and I manufacture. Let's say I make bananas the best, and they make oranges the best. Well, I can make oranges in my country in the United States as well, but I can't make them as well as I make bananas. So what do? I focus on making bananas, and I trade those bananas to Canada for oranges, which they are better at making. That's the whole point of free trade. Free trade lifts all boats. Okay? So if a country is better at making one product, and that's very often the case, or many products, what they do is they'll focus on making those products and then trade those products, which the other country is perhaps not great at manufacturing or making, and everybody wins as a result of it. Okay? Now, there's a couple problems with that. One is some of the sensitive items that you're manufacturing, let's say like computer chips or GPUs, well, those are vital to the economy. If they're not manufactured domestically, you leave yourself up for maybe a national security issue. So there are things like that. But generally speaking, there's a reason they are not manufactured domestically, because that means they can be produced externally for a cheaper price, and then you import them, and then you export what you make more efficiently, and everybody wins. That's the basic idea of free trade. And that's why so many countries around the world have free trade agreements. So everybody wins. So we're in the middle of this right now. As you can see here, there's steel and aluminum tariffs on Canada. Canada imposed 25% tariffs on $20.7 billion of U.S. exports effective March 13, including $8.8 billion in steel and aluminum. Now, I want to talk about steel and aluminum. The Americans need steel and aluminum. There's a reason steel and aluminum are not being produced in the States, because they can't do it as efficiently. It's just that simple. That's why they import from Canada. So our job is to look at getting this done in Canada. Trade. Now, if you impose tariffs on aluminum and steel, what happens to the manufacturer? Well, their costs go up. So when their costs go up, let's say you're making a car, you're General Motors, you're making a car, and now the imported price of steel and aluminum is all of a sudden now up. Well, what happens is you will have to raise the price of that vehicle. That may cause inflation, or people simply won't buy it. What that means is people will be out of work. There'll be high inflation. Costs will go up. This is not a good scenario. So I'm not sure how this all ends, but I think it's a negotiation tactic, okay? And the retaliatory tariffs are also problematic. Now, European Union announced retaliatory tariffs on $28 billion worth of U.S. exports. People are not traveling to the States. The States are in trouble right now. They've gotten themselves in a bit of a mess here. Now, like I said, I don't think this persists for an extended period of time. I think it will resolve itself fairly soon, but we don't know yet. We simply don't know. So we'll see. And again, all this is uncertainty, okay? So the tariffs currently being imposed would be the highest since 1946. Even during Trump's first cycle, as you can see here, from 2016 to 2020, tariffs went up a little bit, but they skyrocketed of late. And by the way, tariffs do not work. They're not good. What happens is you wind up making things in your own country that you're not good at. You're not able to import stuff that you're not good at manufacturing, and everybody loses as a result. People's lives are worse and inflation is higher. This is why I don't think it'll happen. Now, here's a little bit of research, okay? Tax Foundation estimated the impact of tariffs without accounting for any retaliatory tariffs from foreign countries, which there will be, may reduce U.S. economic output by 0.4%. So what is the market doing? Well, the market is pricing in a possible recession, and that's why you've seen this big pullback. This is an induced recession. It didn't have to happen. Okay? So without retaliatory tariffs, without the impact of people not traveling to the States, an economic pullback of 0.4%, which is substantial. Now, furthermore, the threatened tariffs on the EU and all auto imports could further shrink U.S. GDP by 0.3%. And again, this does not take into account like things like people not traveling, etc. Okay? So we have a problem here. And the problem is uncertainty. So we don't know how this all ends. Okay? And as for the tax foundation, all these tariff actions combined could lower U.S. full-time employment by 600,000. Now you count $600,000 jobs lost. Okay? Plus all the jobs that are being eliminated by Doge. Elon Musk is in charge of Doge, and he's eliminating a lot of the federal workers. Now, all of a sudden, a lot of people out of work. What does that mean? They don't have money to buy stuff. And when they don't have money to buy stuff, that means corporate profit decreases. The market is a forward-looking mechanism. It's pricing all this into account today. So if we get some positive surprises, you could have a substantial rally. Now, again, I don't think this happens. I think this is a negotiation tactic. Maybe some tariffs stick, but it's mostly a negotiation tactic, right? To try to get some manufacturing back to U.S. and to negotiate more favorable trade terms with countries like Canada, the European Union, China, etc. Okay. Now, according to the report, the tariffs from the Chinese trade war imposed in 18 and 19, along with those that remain in effect the following years, under the agreement between the two countries, resulted in an additional tax burden of 300 to 600 on the average American household. That's why it's not a good thing. People wind up paying more for the same goods. Jobs get reduced. Okay. So the effect on tariffs on the U.S. economy are going to pile up. And what I'm not taking into account is how impactful is the tourism sector going to be, because the U.S. does have a lot of tourism. People are now refusing to travel to the States. This is going to be problematic. Okay. So if the GDP contracts, okay, by 0.1% in these various fields, you can see how many jobs will be lost. 65 basis point contraction would equal 599,000 jobs lost. And then what about the jobs that are lost because of those people not working? Could be substantial. So I don't think it comes to it. The worst of both worlds is something called stagflation, where you have a stagnant economy because of stuff like tariffs. So people are not buying, they're losing jobs. And you have high inflation at the same time. Why? Because the same goods that you were importing now cost more. So that's called stagflation. That's the worst pretty much economic situation you can be in. Hopefully that doesn't happen and we find a resolution to this sooner rather than later. So let's take a look at historical evidence. Economists widely agree that free trade boosts economic output and income, whereas trade barriers have the opposite effect. We talked about why. You focus on what you are best at manufacturing and you trade for the rest. Everybody wins. Historical data indicates that tariffs lead to higher prices, inflation, and limited availability of goods and services for U.S. business and consumers, ultimately lowering income. That's not good. Reducing employment and decreasing economic output. These are all not good things. Alternatively, tariffs may cause the U.S. dollar to appreciate, which could help offset price increases for consumers. If the U.S. dollar does appreciate, and let's say it appreciates a little bit, but that cost of that good coming across from Canada or China, well, you have a stronger dollar, so it won't be as impactful, but I don't. The dollar probably won't be going up 25%. A stronger dollar would also make U.S. exports less competitive globally, reducing revenue for exports. And this decline would lead to lower economic output and incomes for both workers and capital owners, diminishing incentives for work and investment, and ultimately shrinking the economy. August 2018 analysis from economists at the Federal Reserve Bank of New York warned that Trump administration's intent to use tariffs to narrow the trade deficit would reduce imports and U.S. exports, resulting in little to no change in trade deficit. So this is not a great situation we're in, okay? The IMF used a range of general equilibrium models to estimate the effects of 25% tariffs on all trade between China and the United States, and each model estimated the higher tariffs would bring both countries significant economic losses. It's kind of like war. There are no winners in this war. So think of this as an economic war, and this is the IMF, right? There are also other studies that are cited here as well, but the bottom line is it's simply not good for anyone. People will lose jobs, prices will go up, and that's going to cause all kinds of hardship on the average person, right? So struggling factories with layoffs, rising prices, that creates inflation and economy which is in bad shape. And then people don't feel comfortable. They're not spending. So what are we doing right now? I am on the phones every day raising as much money as possible, and a good amount of money has been coming in. What we're doing is we are buying aggressively on this dip. I know what history tells me. History tells me that every time you have a pullback like this, the markets rebound eventually and go to all-time highs. We believe we're invested in great companies. We're buying aggressively. We are, however, holding a bit of cash. As you can see here, only 94.1% of the portfolio is invested, and that's as of March 25th. We've had some money come in after that. We're probably going to hold around 10% cash and hopefully a little bit more. As more and more money comes to the fund, we'll keep holding more and more cash. So if by April 2nd, because that's that magic date, if the markets pull back a bit more, we will buy aggressively. So we're dipping our toes into the water. I know there was a few purchases made today. Bought some Google, bought some Amazon, bought some Bitcoin through iBit, and we bought some Nvidia. And that's the idea. The idea is to take advantage of the sale. This is what most people have a hard time with. If you look at statistics, most people throw their most money in the markets when their markets are highs. We want to train people that what you do is, or teach people that you want to learn to be the most aggressive when the markets have taken a bit of a beating. So take a bit of a beating and you're probably never going to get the bottom. Nobody ever gets the bottom right. But this is when you want to be aggressive, because if you believe that the markets will go to an all-time high, what does that mean? That means there could be significant upside potential from here. And that's exactly what we're doing. So we're raising our cash position with new money coming in, which is really good. And we're systematically dipping our toes in the water and buying these wonderful companies that we believe are on sale. Okay. So let me know if there's any questions. We don't have a lot of puts written right now. We don't have a lot of calls written right now. Our long exposure is 92.6%. Okay. 92.6%. So we're pretty invested, but I would expect that number to probably go below 90, which means we'll go over 10% cash. And if it's over 10% cash, we're not going to be writing or selling puts. We will be just simply buying the stock. Okay. But the portfolio manager obviously will have to decide that. But that's exactly what we're doing. Why? Because history tells us that is what needs to be done right now. Okay. And could it get worse? Absolutely. But this is the whole point. Okay. What to look out for, okay, in the next couple months. April tends to be a volatile month, okay? The first part of April tends to be the strongest, while the latter part happens to be flat. From 1970 to 2022, the NASDAQ has averaged about a gain of 1.4% and has been positive 65% of the time. So we are still in that favorable period of time seasonality-wise, okay? And if the economy starts stagnating, as long as we don't have inflation, you can anticipate some rate cuts both in Canada and the US. Now, the thing to take note about that is the US has a $37 trillion debt. Approximately 10 trillion of that rolls over this year. Now, the Federal Reserve and the president are separate entities. The president just can't go to the Federal Reserve, lower interest rates. No, that's not how it works. They are independent. Okay? So if the Federal Reserve, right, the US central bank, sees that the economy is faltering, and as long as we don't have inflation, they will start lowering interest rates. And that's what Jerome Powell said a little while ago, is that anticipate a couple rate cuts by the end of the year. However, if markets continue to weaken, if the economy continues to weaken, as long as we don't have inflation, then you can anticipate some rate cuts. Now, this might be the reason why if the Americans have $10 trillion in debt, which needs to be renewed this year. Okay, so when I mean $37 trillion of debt, they have an economy that's about $30 trillion. So the whole country in any given year produces about $30 trillion of goods and services. Okay, but their accumulated debt, all the money they've borrowed so far, is $37 trillion. Now, those are sometimes borrowed in 1-year terms, 2-year terms, 3-year, 5-year, 10-year, etc. 10 trillion of that approximately is coming due this year. So it will have to get renewed because that debt's not being paid down. And obviously the American government, they would want to renew that debt at a lower interest rate. And that might be another reason why these tariffs are being done, to artificially weaken the economy so they can roll over this debt at a more favorable rate. But it's all speculation at this point in time. These are potential reasons why. But the last point I want to leave you with, guys, is simple. Just remember what history tells you. History tells you the markets have always gone to an all-time high, and corrections are very much a part of the market. So nobody knows where the bottom is going to be. All we know is that the lower they go, the more we'll be buying. And that is how you do really well in the long run. That's what the best investors do. And that's exactly what we'll be doing. Let me know if there's any questions, guys. Otherwise, please contact myself, Matthew, or David if you have any questions at all about the fund. We'd be happy to answer for you. And obviously, as the disclaimer is always in place. So thank you so much for joining us today. This call will be up on YouTube shortly.